Evening, everyone. Welcome to the annual High Street Wealth Warriors presentation, where we have a look at the year 2022 in review and also share our outlook for the remainder of 2023. We'll be covering the macro environment as usual. We don't believe that we can forecast these things, but it is very important to get a sense of where we lie. We'll then move on to the performance review with a special focus on how we performed within the various themes. Wealth Warriors is a thematic fund by nature, and Charlie will go in depth into two of our major themes. From there on, we'll move on to the outlook. We believe there's a lot of value, or there's a lot of opportunity in with where share prices lie at the moment. And then we'll round off for a Q&A session. So if I can dive into it. First of all, the last year in review, we can see that markets were generally weak across the board, most notably within the indices focused on growth, with the FANG Plus index down 40%, and the growth-heavy Nasdaq Composite down 32.5%. Value had a relatively good year, with the Dow relatively flat, and that generated a return of 18.1% for the S&P 500 and 18.4% down for the MSCI World, which is the fund's benchmark. Another standout performer was the US dollar, with extremely strong across the board, as market declines led investors to the safe haven of the US dollar. Moving to the fund's performance, we can see that last year was a particularly bad year for the fund, generating a loss of 46.4% relative to the benchmark down 18.4%. Unprecedented increases in interest rates were largely responsible for the fund's poor performance, with rising interest rates disproportionately impacting growth-orientated funds, where the emphasis is on future cash flows. And in some cases, these companies are still running at losses, expected to break even in 2 to 3 years. But we believe these companies have significant moats, and they will be able to turn the profitability tap on at their discretion. Worth noting is that funds with similar mandates, how they performed during the year. The average of the basket that we track was down 40.5%, and the individual fund performances ranged between minus 30% to minus 67%. So it was a very poor year for funds with similar mandates. However, that is no excuse. It was a poor year for us, and now we need to look forward. So as I mentioned, interest rates were the number one culprit for the poor performance last year. As fund managers, we are more focused on the underlying company fundamentals. We believe we have a lot more accuracy in predicting those variables as opposed to macroeconomic variables. No one could have seen the Russia-Ukraine war happening, which did have a big impact on inflation rates. Not to say that monetary policy wasn't very, very loose going into that on the back of the COVID lockdowns and the actions that the central bankers took. So globalization and innovation, on which the fund is premised, has seen inflation on a continued downtrend for the past 30 years. Case in point will be the television. Today, per square inch that you're paying for a television is down 98% over the past 30 years. So we can just see what globalization and, more importantly, innovation does to prices. Just speaking to the chart there, I did mention that it was unprecedented. And we've seen inflation at levels which was last seen in 1990. Moving forward, what are market expectations? As we mentioned in our June presentation of last year, we did see inflation peaking at these levels, and now we see it set to ease, and market participants agree. However, I would like to state that market participants are often very far off the mark, and hence we don't put too much weight in predicting the macroeconomic environment. Going into 2022, the market expected rate increases of 0.8% during the year. That's in the US. And they came in at 4.25%, as mentioned, to combat the runaway inflation. So market participants see inflation easing and subsequently interest rates easing as well. However, we are going to focus more on the macro. Before we get there, just putting last year's interest rate move into perspective. It was the fastest interest rate hiking rate cycle of living memory. We can see various other years there, with 1988 being the steepest. It took 8 months for interest rates to rise 3%. In contrast, it took only 2 months for interest rates during this rate hiking cycle to reach a similar level. On the other end of the spectrum, a moderate rate hiking cycle as seen in 2015, it took 3 years to increase by 2%. And once again, this interest rate hiking cycle saw rates increase by that magnitude in only 2 months. So where do we stand today? We are at a rate of approximately 4.5 to 4.75% in the States. Market participants do see further rate increases into the year. However, then they see that plateauing and coming off. So it's all very well and all talking about the macro, but what impact does that have on markets? Once again, we are not making any predictions here, but we did find it a useful exercise to go back in history and see how markets performed during interest rate hiking cycles. So we went back to 1971, 50 years, and there were 8 rate hiking cycles that we covered. If I can first take you to the 1-year number, you can see that the market on average was pretty flat 1 year post the initiation of the interest rate hiking cycle. Over 3 years, generally it delivered a positive return, with the average return being 13% on the S&P 500 and 16% on the more growth-orientated NASDAQ composite. The picture looks rosier after 5 years, with a return of 35 and 55% respectively. Interestingly, during the rate hiking cycles, the market generally went up. We can see the S&P 500 up 10% and the NASDAQ up 26%. However, if we zoom in to what is currently happening, so the current cycle, since they began raising rates 1 year ago, we can see that generally the market has been quite weak, with the S&P 500 or 14% and the growth heavy NASDAQ, more akin to the stocks that we hold in Wealth Warriors, is down 26%. So using history as a guide, rising interest rates do not necessarily mean subsequent low market returns. I think that is evidenced in this chart over here. We can see that company-specific factors account for roughly 65% of share price performance. While we look at the macro, which covers the sector analysis, sector and industry analysis, as well as the region, that accounts for a relatively small percent of the returns. So once again, our job at High Street here is to focus on the company fundamentals. In the short term, share prices will be driven by macroeconomic and geopolitical events, of which we feel we have no forecasting ability. So if we move to the macro, on a broad level, sorry, I know this is a very busy chart, but if we start on the top left, if we look at the S&P 500, first we can see the change in earnings per share forecasts during the year of 2022. And these are forecasts 3 to 5 years out. Analysts were generally positive on earnings, and there was a positive re-rating of 3% that came through. On the other side, in terms of price, we saw that the S&P 500 came off approximately 19%. So we do get excited when the price underperforms the fundamentals, because either it means that these shares or the index was significantly overvalued to begin with, or there is opportunity appearing at these levels. If I can take you to the right-hand side of that graphic, the NASDAQ composite, applying much the same methodology, we can see that there was a contraction in the earnings per share forecast 3 to 5 years out of 6%. However, prices or price of the index came off 33%, so significantly more than the fundamentals. So that's 2022 in review. What do we see going forward? So our numbers indicate that on the S&P 500, we expect a 4.1% annualized return over the next 5 years, while analysts largely corroborate that with a forecast of 11.2% over the next 12 months. Moving on to the NASDAQ, as I said, a more similar mandate to what we invest in Wealth Warriors. We are more optimistic. We see a 9.5% annualized return over the next 5 years. And analysts once again corroborate that with a 14.2% upside over the next 12 months. So we can see that in terms of fundamentals, prices got hit harder last year than the fundamentals, in this case, the earnings per share forecasts, and analysts see more upside for the growth-heavy NASDAQ. If we look to history, over the past 10 years, growth has performed extremely well, outperforming value by some 60% over that 10-year period. Yes, last year was the poorest year of performance relative to value going back to 1971, with growth underperforming by 24%. This is a very significant number. However, if you remember, post the COVID lockdowns, growth really benefited from the loose monetary policy, as well as their business models sort of benefiting from the lockdown measures that we saw. So we do not believe it's a structural change. We do believe growth will continue to outperform value. And this is exactly what the Wealth Warriors mandate entails. Moving on to the fund specifics. As mentioned, it was a very poor year last year for Wealth Warriors, down 46.4%. The losses were widespread and came from all the themes, most notably e-commerce, cybersecurity, advertising, social media, and data processing. And this, despite only increasing our exposure to the cybersecurity and data processing themes during the year. So they really got sold off sharply towards the end of last year as interest rate increases continued to come through. On the far right, you'll see that there was only software as a service that came in positive. However, other than that, there was not much to talk home about. We'll end off with a slide showing the year-to-date performances. of the various shares within the fund, and things are looking a lot better. However, we can't get away from this, and we realize that a lot of work has to be done to make up for the losses seen last year. Just from a geographical standpoint, going into last year, we had a 24% exposure to China, and over the year, in 3 equal tranches, in March, June, and September, we decided to reduce our Chinese exposure to 0. I think we've discussed in depth the merits which we saw in China, and they were largely premised on regulation easing and these growth companies being allowed to thrive again and innovate, and ultimately that would lead to a better share price performance. That would also largely be assisted by economic stimulus provided by the Chinese government, which would also drive share prices. What we've seen is that there has been a resurgence in Chinese share prices recently. However, our models do not indicate good upside here on a 5-year basis, and we feel that the regulatory headwinds are here to stay, and these companies will be hamstringed to a certain degree, as they are not allowed to operate in a free world economy. So we decided that China is not capitalistic in nature, and there are too many obstacles to growth within these companies. Charlie, hand over to you.
Okay, thanks, Ross. To look at our thematic exposure and how that's changed going into 2022 versus going into 23, you'll see the big reductions were in big tech and e-commerce, and this largely is due to the reduction in Chinese exposure. We had big exposure to the likes of Alibaba, Tencent, and JD.com across those themes, and so the function of, or the reduction of these themes was more a function of the Chinese switch rather than the themes themselves. But because of the similar level of drawdowns with China and America, we took advantage of reduced share prices in the States and really beefed up a number of themes, primarily software as a service, cybersecurity, data processing, and then gaming and streaming. I'll speak to 2 of those themes, cybersecurity and data processing, shortly, just as a bit of a case study to give an indication of why we're so positive about these themes and why they make up the largest weights across our 13 odd themes. But just before I do that, I'll mention the fact that we did sell out of a number of our smaller cap shares. We thought in an environment with interest rates that are significantly higher, and growth that's slowing down, these companies, these small cap companies who are a long way away from profitability, were ones that we decided did not fit the mandate, that being cannabis and then some fintech companies. Yeah, we did a lot of work to consolidate into companies who show a clear roadmap to profitability. And yeah, it's a non-negotiable. We need to see cash flow and cash coming to the bottom line. So to take cybersecurity as an example, the chart on your left shows the current and expected worldwide cost of cybercrime in trillions of US dollars. And you'll see just how rapidly it has been increasing and is expected to increase. Constant digitalization is increasing cybercrime. There are enormous opportunities for criminals to exploit both public, private, and government weaknesses. I mean, crimes for the public are obviously things like credit card fraud, ransomware, and extortion. People signing up to nefarious, or signing up to software which turns out to be nefarious, locking their computer. And this is especially the case in corporations. Hackers these days are not just sort of loner individuals in their basements. They're now enormous organizations, very well kitted out, often sponsored by states programs in the likes of Russia, North Korea, and China. And it's now a serious business, cybercrime. Corporations are very vulnerable to attacks, like denial of service, phishing, and ransomware. You may have seen last or in the previous few years some big headlines about corporations getting locked down, having to pay X number of bitcoins to free their systems. There was the Cardinal Pipeline hack in 2020, 2021, where something like half of the fuel flowing to the west coast of America was shut down, and the company had to pay millions of dollars to open up their systems. The average cost last year was $4.35 million, and it means the cybersecurity and paying for these products is becoming a non-negotiable cost of doing business. Just to put some context into these numbers, trillion is quite a hard number to picture. But 2027, this is the FBI and IMF expect $24 trillion dollars of cybercrime, or the cost of cybercrime worldwide. And for a bit of context, the US GDP is expected to be around 30 trillion in 2027. So it's an enormous cost to businesses, to individuals, and to governments, and it is going to become a non-negotiable cost of life. Subsequently, we increased our exposure from 3 to 16%. We were slightly more heavily weighted going into the back of 2020, but unfortunately, a number of companies that we were invested in got taken private. It's a big space for private equity. There's been a lot of activity, and we had two companies taken private from our fund. So we had to expand and really sort of identify the entire universe, and we identified three specific themes within cybersecurity that we wanted exposure to, and we hold 5 companies across those areas. So in network security, this is your more traditional localized security package where you buy a firewall and other sort of affiliated products, and that protects your office block or your home, and it creates a safe network which traffic can go through. We've invested in 2 companies within that, Fortinet and Palo Alto, both very profitable, both growing nicely. And yeah, I'd say of the entire suite, these are perhaps your more legacy, but very much essential services for both businesses and individuals. However, in the world we live in now, people don't just work in the office, and so you can't just have this bubble of security within one building. You now need to be on the move. People work on their phones, they work on their laptops at home, on the train, in the library, in a coffee shop. And so there needs to be another layer of protection beyond that of your network security. So that's where cloud protection and threat detection come in. And we've invested in 3 companies within those 2 themes, within those 2 sectors, Zscaler, SentinelOne, and CrowdStrike. These companies are growing significantly faster than your legacy players, and they are really serving the decentralized world that we now live in. So they use AI and machine learning models to track what your average user does on a machine, your average schedule, replying to emails, copying certain files, etc. And when a action happens that is far beyond what a normal employee would do, for example, copying mass amounts of files or emailing people that you shouldn't be emailing, trying to access things you shouldn't access, these systems light up, they lock you down and identify the criminal. So yeah, we're very happy with our exposure across this theme. We think it's a theme that's going to continue to grow and move towards profitability as it becomes an essential service. And there are a number of tailwinds you'll see at the bottom: cloud computing, digitalization, decentralization, and work from home, that are all driving this theme forwards, and we think that it's not going to go anywhere. Secondly, to speak to data processing, chart on the left is from McKinsey, and it speaks to the global semiconductor market value in 2021 and then 2030. And this market is made up of computing, wireless communication, automotive, industrial, consumer electronics, and then wired communication. Interestingly, 70% of this growth is driven by just three industries. The three biggest ones you can see at the bottom of the chart being automotive, computation and data storage, and then wireless. To speak to automotive, first of all, the average modern car contains around 1,500 semiconductors. They really are the engines of digital life, and they power or they provide the processing power for all sorts of digital services. But as we move towards electric vehicles, and a number of governments around the world are starting to enforce the end of the internal combustion engine and the move towards electric, some rapidly within the next 10 years are not going to be selling any new internal combustion engines. The demand for these semiconductors within automotive alone is massive. And we see, or McKinsey rather sees, around 3,500 single semiconductors in electric vehicles alone. The cost by 2030 of these semiconductors could be around $4,000 versus around $500 for a traditional internal combustion engine car. The other two sectors, being consumer electronics, computation and data storage, and wireless, are both going to be driven by AI, cloud computing, and then the rise of smartphones and 5G. And these sort of consumer the consumer demand for these products, as well as the corporate demand, is expected to be rapid. These are also strategically important resources. The US government recently put into law or legislated the CHIPS Act, which is allocating around $280 billion for spending in US chip production, design, R&D over the next 10 years. Not only are these important for consumers, but these make up crucial parts of weapon systems and government computing power. And they're going to become an ever more important resource as globalization and the sort of decreases and the aim to secure supply chain increases. And then finally, AI technology. You all would have seen the exponential rise of ChatGPT. It became the fastest software to reach a million users and also 5 million users, in just a number of days versus a number of months for the likes of Instagram and Facebook. So this technology is rapid, and it's still in its infancy. AI requires an enormous amount of computing power, and that is driven by these chips. And as they sort of integrate more into both consumer life and into corporate life, that demand is just expected to be exponential. To put some sort of figures on that, Nvidia currently has a revenue of around $33 billion, and there are some forecasts that AI alone could increase their top line by about $10 billion in the coming years. So enormous growth potential, and that's why we've increased our exposure here from 8% to 17%. Just like cybersecurity, we wanted to have exposure across the supply chain. So that meant investing in 5 companies in manufacturing, fabless design, data infrastructure, and automotive and industrial. And to speak to a couple of those quickly, ASML in manufacturing is probably one of the most important companies you may never have heard of. They have an absolute monopoly in the production of lithography machines, and these essentially etch the silicon wafers with extreme ultraviolet light to provide the patterns which these circuits are built on. And ASML is a Dutch company. It has unbelievable moats, rock solid margins at about 27% on the profit line, and just a phenomenal company continuing to grow. In terms of fabless design, these are ones you probably are more familiar with, NVIDIA and AMD, and they provide the structure for these chips, which they then send off to fabs around the world to manufacture. So they are primarily involved in the design of CPUs and GPUs, and these are chips that we use day to day in our cars, in our phones, in our microwaves. They're everywhere. Moving on to data infrastructure, this moves or is really driven by cloud computing, and Marvel is a company that provides the hardware to really fuel these data centers and the rapid growth we've seen in cloud computing. And then finally, NXP in automotive and industrial, where space is often a big issue, and they provide systems on a chip that integrate both CPUs and GPUs onto one unit. So yeah, a fantastic theme, one we're very positive on, and the tailwinds similar to cloud computing. They're both driven by digitalization, but particularly by AI automation, and then EVs and autonomous driving, gaming, and VR. So yeah, I think to conclude on themes, we're very positive about the themes we're seeing. I think results coming out so far for Q4 last year have been largely positive. We've seen a good move to profitability from companies that haven't been so focused on that in the past. And very positive to see where these themes can go. I'll hand over to Ross.
Thanks, Charlie. If I can summarize, in June of last year, we saw inflation peaking, where now it seems that is the case, and inflation is now starting to ease. However, as I mentioned many times, we are not macroeconomists, and therefore we do not pay much attention. As we've seen, equity markets generally perform well post the initiation of an interest rate hiking cycle. We also saw COVID in China was largely being contained, and they were engaging in large stimulus plans. However, because they do not adhere to the free market principles, we've decided to exit our position there. The Russia-Ukraine conflict, once again, we do not have any firm sort of forecast as to what's going to happen there. However, we do see it continuing as it's a very, very difficult scenario with a lot of moving parts. With inflation easing, we see a preference for growth equities, despite a lot of talk about a likely recession. Some estimate there's 90% certainty at this point. However, as Charlie mentioned, the fundamentals of these companies remain strong, and they are largely meeting analyst and management expectations. As always, we believe that innovation and disruption will continue to capture market share. As such, we've increased our cybersecurity and data processing to become the two major driving themes within the fund. Admittedly, we did get in a little bit too early. However, we believe that the tailwinds are there, and in the long term, valuation becomes less important, and compounding cash flows are what are hopefully going to drive the share prices of these companies moving forward. To end up with a little bit of positive news, because last year wasn't very comfortable for any of our investors. You can see that we did minus 46% as detailed, relative to the benchmark, minus 18. Year to date, we've got up to a pretty strong start, up 19%, with the benchmark up 13.6%. Admittedly, we still have a long way to go. However, we feel that the sentiment is starting to return to a lot of these growth names following the almost record-setting year of underperformance for growth relative to value. Just as an indication, as I did on the second slide covering the performance, how have funds with similar mandates performed year to date? The average return has been 16%, and the range has been from positive 8 through to 27%. So we are performing nicely. However, we feel the style is generally performing nicely, with sentiment turning positive. Digging into the individual shares which we hold within Wealth Warriors, you can see that the performance is pretty broad based. A great performance from our data processing companies in NVIDIA, AMD, Marvel, all near the top of the list. Pleasingly, Meta has also performed very nicely. I think it's worth mentioning there that a lot of these companies, just about all of them, have engaged in material cost-cutting initiatives to bolster the bottom line. So we've always believed that these companies, with their moat, could be profitable. A lot of them are profitable, but a lot more profitable than what we are seeing today. They spend an extraordinarily large amount on sales and marketing and research and development, which erodes their profitability. However, we do feel that they have the capacity to reduce these expenses and bring the cash conversion from future years to current. As such, we've seen Meta up 49% year to date, and for a company of its size, that's a significant performance and a shift in sentiment on that. So it's been a good year. We think things can continue. We continue to monitor the fundamentals on an ongoing basis. We do welcome all our investors, as always, to schedule a presentation with us, and we can walk you through our highway process, exactly how we do things, so you can see that there is a lot of substance to our process, and we're not merely here to present on the fund's performance. I think we can open it up to Q&A. If anyone has any questions, please.
Okay, we'll just give a few seconds for some questions to come in. Okay, first question. I see you only have a 3% weighting in the environment theme. Do you see this increasing in the future? What are your thoughts on ESG as a theme?
Okay, I think I'll jump in here. ESG has really gained in popularity. A lot of these large index providers are jumping on the bandwagon, and we've seen flows into the specific theme increase drastically. However, if you take a deeper look into the underlying holdings of these ETFs, they aren't that much different from that of the S&P 500. So it's very nascent in its adoption. We do believe that environmental concerns are here to stay, and ESG as a whole is here to stay. When listening to company presentations, there'll be at least 10-15 minutes dedicated to ESG. So we do believe it as a theme that has traction. However, having looked into the theme, we haven't found any companies which we believe have a sustainable competitive position that are trading at attractive valuations. So I think the intention is definitely to increase it, but we won't simply invest in a theme based on its prospects if there isn't value to be had. Because at the end of the day, ESG is a consideration for our individual clients. Our duty to those clients is to produce positive returns, which we are focused on.
Perfect. Second question, are you concerned about an impending recession? Yeah, I guess I can speak to that. I think a recession is always concerning. In terms of the macroeconomic cycle, you'd rather be in the growth phase with looser monetary policy. But the reality is that innovation and disruption solves problems, and a recession brings with it a number of problems. The companies who survive recessions are ones which are, very good in terms of their moat and their competitive advantage, in terms of their cash control. And we believe we invest and pick those companies. And these are the companies that will provide solutions in a recession and will solve those problems.
And if I can add to that, just as we did that analysis into what happened or how do markets perform in times of rising interest rates, we did a similar analysis into how markets perform going into a recession and beyond. And generally, markets recover within 1 to 2 years and produce positive, meaningfully positive returns 3 to 5 years out. The market has come off quite significantly. It's recovered a bit, but we believe a lot of it's in the price, and we're not likely. We don't believe to see significant drawdowns from these levels.
Okay, could you say a bit more about the China fundamentals? What made you change sentiment?
Want to take it?
Yeah. So I think China, it was very difficult because we had been long China for a long time and really saw the merits of particularly innovation in a growing an enormous society. And the Chinese do take to digitalization like no other nation. And so you do see this exponential growth curve in China in terms of adoption of technology relative to other countries. But unfortunately, our thesis on the political sphere was wrong. We expected China to be more flexible in terms of the COVID zero policy, and that had enormous ramifications on both GDP growth and therefore share price performance. And we were actually very fortuitous in the fact that as the China fundamentals were reducing and the companies had sort of sold off significantly, US companies had sold off by a similar level. So when looking at a purely objective basis on our valuation models and on external analyst forecasts, we saw that it was an opportune time to switch because the upside on US names that had been sold off by a similar extent were equal, if not better, than on their Chinese counterparts. So it was a difficult decision because we do think that there is potential, massive potential for innovation and sort of performance in China. But unfortunately, the regulatory and geopolitical reality meant that we were much more comfortable looking for that upside in the US after a similar drawdown. So have you got anything to say?
Yeah, I think that covers it very nicely. I think if I could summarize things, one of the key factors we look for is the quality of management within the company. In this case, I'm not saying that China has poor quality of management, but the degree to which they can control the company is limited by what's put down on them from the government. So we feel they are pretty hamstrung to that degree, and they are at the whims of the Chinese government. And I think common prosperity is case in point, where they are basically forced into giving back to society with no meaningful return.
Yeah, absolutely. Okay, next question. When you speak to fundamentals, what are the metrics you are spending the most time looking at? Cover.
Okay. Yeah, so as Chief Investment Officer, my focus has been on driving the processes. Charlie is a lot more equipped to speak to the themes. But when looking at the fundamentals, we basically try to purchase compounding cash flows at a reasonable price. What that means, we'll look at the business fundamentals. Charlie's mentioned a few already. Those will be margins, defendable, high returns on capital. Together, those two indication of the competitive strength of the company. We then move over to the balance sheet. We either want net cash or strong interest coverage ratio. And ultimately, we want strong cash conversion. What we then do is we look 3 to 5 years out and we factor in the growth of these cash flows and then arrive at a fair price where we think the instrument should trade at. We then compare this to the prevailing price, and hence that's how we get our internal rate of return number. Important to note is that this is just the valuation stage of this process is not the be all end all. As mentioned, over the longer term, it's compounding cash flows that drive share price performance and not necessarily the entry point. As such, when we buy a company, we'll hold it for the long term and keep the churn in the fund to a minimum. That may be contrary to what's been happening over the past 2 years as we've rebalanced the fund. However, the goal now is to keep that churn to a minimum.
Okay, next one, any view on renewable energy stocks versus traditional fossil fuel companies, excluding Shell and BP driven earnings, a result of the energy crisis created by the Ukraine-Russian war and Western Europe dependence on Russian gas. Sorry. Yeah, I think sort of to go back to what Ross was saying about ESG, we're very active in the search for any sort of environment or any company that will fit our environment theme. It's something that we think is essential and is a very exciting opportunity. So in that sense, we would rather look towards a renewable energy player rather than a traditional oil and gas company, given the focus on innovation and disruption. However, as Ross says, we've been scouring the universe and unfortunately haven't found a company that meets our sort of strict criteria on all the fundamentals that he's just mentioned. So it's something that we are continuously looking at, and we'll certainly do a sort of a deep dive when we've come across a company that hits all our metrics in that space.
Yeah, I think if I can add, it's a very difficult space to invest in a company that has a clear market leading position. We've looked at everything from the battery producers to the big solar providers in the States, to the solar panel manufacturers coming out of China. We think we've looked across a broad spectrum and we haven't managed to find anything. What we have invested in is MP Materials. They basically are involved in the production of rare earth magnets, which are vital in a number of use cases, but in this case, most notably wind turbines. If you drive on the way to PE and you drive past the wind farms there, those wind turbines have approximately 1 to 1.5 tons of rare earth magnets inside of them. So then you add to that the demand for rare earth oxides in electric vehicles, as well as in defense, for example, missiles and the jets themselves. We think it's a very promising outlook for this company as they are set to become the first and only rare earth magnet producer in the Western Hemisphere. So we are very positive on that company. However, it is still a relatively small cap and largely dependent on the rare earth pricing, which is very volatile. So we don't have a very large weighting to that instrument.
Okay, with the population of India surpassing China, what are you looking at with respect to India? Yeah, I think that's an excellent question. And India is a very exciting, young and up and coming population. I think you can see the level of interest in India by looking at the investment of big tech companies. Facebook has gone heavily into India to monetize WhatsApp. I think there are around 500 million WhatsApp users in India that are sort of trialing the WhatsApp business products, and India has become essentially a test ground for monetizing WhatsApp through advertising, through payments space, and yeah, that's a sort of a test ground before it gets released to the rest of the world. Process, which is the obviously the NASPA's what do we say? Not subsidiary.
Crosshold.
Cross-holding. Thank you. Process has gone heavily into India with both payments and with food delivery. So yeah, I think it's a very exciting space. I think that as of yet, we haven't seen anything that again ticks all those boxes, particularly with regards to profitability. I think in the current environment and what last year has shown is that cash profits on the bottom line matter more than anything at the moment. And yeah, we won't invest in any companies that don't have a clear roadmap to profitability. That being said, I think India is definitely one to watch and something we're definitely going to be sort of increasingly looking at over the coming years. What have you learned from the dramatic collapse of the fund's value last year? Was the talk of rising interest rates last year not an early signal to correct the holdings earlier than it was?
Sure. Well, yeah, it was a very poor performance for the fund, down 47 odd percent. However, if we look at funds with similar mandates, as well as the growth heavy NASDAQ composite, you can see they were also down significantly. However, we are not happy with our performance, given that we are about 14% worse than the NASDAQ composite. I think what we can learn is that we need to balance the portfolio across growth potential and fundamental strength. As Charlie's mentioned on numerous occasions, the shift has gone in the market and in high street as well onto current profitability. So therefore, all these companies with profitability 3 years out plus were sold off very, very sharply. Not to say that we still don't believe in the story. However, we think that they are going to be more volatile. So we have decreased our exposure to not necessarily the smaller caps, but the companies with profitability set to come through only in 2 to 3 years. In terms of interest rates, as I mentioned in the beginning, going into the year, the market expected rate increases of 0.8% and it came in at 4.25%. So macro economics is not what we do here at High Street. Just as likely as interest rates came in stronger than expected, they could have come in weaker than expected. We just do not know, and we just have to focus on the fundamentals. So the mandate of the fund is to invest in innovative companies that are benefiting and also driving changes in consumer behavior, which I think, if you look across the holdings there, we are largely meeting that mandate. However, we can't shirk from last year's performance, and we are sticking to our guns, and we see good potential from these levels.
Okay, I think we'll just give a minute or two just for any final questions before we close up.
Yeah, in the meantime, I'd just like to say we thank you for your support. We know last year was a very difficult year. We hope that we have been forthcoming in our disclosure, and we welcome any chance to communicate with you if you have any concerns or would like to find out more about our process. We really do believe that we have the team in place. We've spent a lot of time and effort on this. We've now got 3 CFA charter holders and an additional 2 which are waiting for the required work experience. So we think we've got the team. We've built the processes. We'll be happy to show them to you, and we do believe that we can regain some of that lost ground going forward.